Hey everybody, Craig Moser here. It's the ninth day of November. This year has blown past. There's been so much going on, and the news is crazy, all this other stuff. But just wanted to give you a brief update and have a chance to go through where we are as far as markets are concerned. So let's just kind of start at the beginning here. Hang on a second. Let me get my handy dandy charting service going here, and we'll share a screen or two and try to make this fairly quick for you. Okay, so we are looking at a chart of what most people call the Standard & Poor's 500 calls it the market. And we're trying to see where we are in relationship to different points in time. Now, I will tell you, it's interesting to listen to the news media because a lot of times you're looking at things that are point in time returns and trying to extrapolate where you are in an investment. So let's use the S&P and say, okay, if we had been an investor, put our new dollars to work in this period of time, which was January the 3rd of January 2022 is where it was, Jan 3, 2022. We would have bought in at 48.13.97. Okay, so that thing went down a lot, and the decline basically was over with around October the 10th, right around that area. And it was down from whatever 4,800 down to 3,500, basic terms, generality, but that. So a large decline. And then if we had measured from, say, January, obviously that's a different set of numbers. So measuring from January, we get to forget all of those losses that occurred and measure again from right around January. Market went up, went back down, so that up sort of stopped at 45.98. I'm going to call it 4,600 to round up, and then went down to as much as 41.30-ish, right in that range. And now we're having a little bump up, which is great. But if you were invested in this index back in January of the previous year and had not sold it, you haven't made any money yet. So it's all perspective, All right, so let's look at some of the others. Emerging markets, just because that's the one that popped up in my mind. Not so hot this year. Not so hot last year. Not really that hot since right in here, which again, you're looking at February of 2021. So Russia, India, China, those types of countries in this particular index, you would think, yeah, that I can understand why these are down, but I mean, we went from 69, we're at 47, so that's what, $22 a share buying this particular ETF, which is the way we could buy this index. You can't just buy an index. You have to get a Vanguard or a BlackRock or a Fidelity or somebody to put the index together for you so you can actually buy it. If we look at Europe, Australia, and the Far East, I've said this a million times, but that is an index that deals with the more developed countries. So Great Britain, France, Germany, Australia, New Zealand area, Canada, Japan, those types of countries are in this particular index. So sort of universally around sometime last year or 2021, I should say, the market's peaked. So for the developed foreign, around September was their market top, had a substantial drop right in here. So if we were using this ETF, we get 51.25 versus, let's just call it 78.4-ish. And you look at this and you go, wow, fairly substantial decline. And then if we're measuring from January, let me get it pretty much right there, just to see where my cursor is right here. Not so much of anything's really happened. But again, Wall Street measures January to December. I wouldn't do that. I would measure from where I started from, but a lot of people don't. All right, so next up would be, let's look at the bond market. So its market high was way back here somewhere. Sorry, didn't mark that up for you before I got started. But around right here, which was August of 2020, think about what was happening. The government was dropping interest rates, which makes the current price of the bonds that you would buy higher. And then somewhere in here, we started seeing Jay Powell raise interest rates. So, okay, declined. I mean, from here, which was 120 on this particular exchange traded fund, and it dropped down to as low as 91.73, and now we're sort of staying in this range right here of about 94 for that substantial drop. So the flip side of this is that we do not have 0.25% rates of return. We're in the fives in here. So again, higher yields, lower prices. Let me switch screens for a second because I like this bond idea. I want to talk about it for just a second. I took a chart because you hear inverted yield curve a lot. And what the heck does that mean? Might be a good question. So here is the yield curve for, yesterday was when this stopped. So you can see if you buy something on the short end of the curve, maturing very, very quickly, 1 month, 2 months, 3 months, and so on, right in this range right here is your highest rates. Interest rates drop down, and we're using a U.S. Treasury here, once we get past about a year. And if you look at somebody that is trying to decide whether they buy one of these bonds that matures in 10 years or buying one that matures in, let's say, 1 year, 6 months, somewhere in there, it's very tempting to go short because the rate is higher. If we're near the end of rate increases, which many believe that we are, then what you'll see is this curve begin to pick back up to where the short part of the yield curve drops down, and eventually it'll look like, the line that you think it should, where something that matures way out in the future it would mature, would pay a higher interest rate than saying, okay, a 4.49 for a 10-year. So eventually that will happen. If we measure from, let's say we measured from 11/8/2020. Let's do that one. Something different happens, right? Why? Because rates were very low on that day. And so you had to reach out to 20 years, 30 years to pick up a yield of 1.6. Not worth it, right? So that's why you see back in the day, people not buying these bonds for anything other than maybe a little bit of principal security, whereas today people are buying yield. So think about it. If you look at that same time window, the short-term stuff right now is very attractive. The downside to buying a short CD or a short bond of any kind is it'll be gone in about a year or so, whatever the maturity date is. Can you reproduce that price, that yield, if you will, out in the future? So just understand that if you buy a lot of short-term CDs, you'll get paid for a little while, but can you put yourself in a position to where those yields will be in your portfolio for a long period of time if the Fed turns around and drops the rate? Okay, so let me get finished up here. I know you're bored, but I want you to kind of see where my mind is and understand that short-term data, you have to understand that that's not really very good data, frankly. I think I did gold. Let's do gold in here. So gold from its highest point, at least over the last 5-year window, was right here around August 20. And you can see down and up and down and up. Right now it's kind of sort of up, and not near the highs, but close. I mean, they're pretty close. I mean, 194 to 181 in the price of this particular gold trust that I can buy here from S&P. But, gold prices are kind of going sideways and have been for quite some time, since August of 2020. Again, a yellow piece of metal, sometimes considered to be an alternative currency. I don't know. It's something that if you see a lot of fear in the streets, people buy gold. All right, if we do oil, now this is not the price of oil. But this is a chart showing for the last 5 years that oil prices were much higher. Volatility. This was during the last part of Trump's presidency, and the Saudis really dropped the interest rates down. So that was the big reason there. And then oil prices have crept up, hit their short-term high back on June of 2022, and now those prices are moderating. Okay, so that pretty much brings us up to date on most things. If you have questions, of course, give us a call at 336-448-1086. Happy to help you and try to answer questions, provide second opinions. We're a financial planning firm. We do, if you're talking about retirement, we do a full retirement planning set up for you so that we look at the future today, look at the volatility of your portfolios, give you projections for income and what you can achieve, probabilities of success and that type of thing. One of the components is you have to have the engine to drive the motor, and that's this thing right here, the markets and things that you have to invest in. That's why we talk about it. All right, make it a good rest of November, and we will talk to you later.